Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, November 9th, 2022. Starting with our economic release spotlight today, just wanted to highlight the Chinese inflation data for the month of October, which slowed. So on a headline basis, we sold 70 bips to 2.1%. That's the lowest print we've seen since March. Core was flat, unchanged, at only 0.6% on a year-over-year basis. That's tied for the lowest print we've seen since March of last year. And then manufacturing PPI, which is very highly correlated to GDP, nominal GDP in the services sector, which is a very important metric to track as it relates to Chinese demand for raw materials. That decelerated 160 basis points to 3.5%. That's the lowest print we've seen, or to minus 3.5%. So manufacturing PPI deflation, that's the lowest level we've seen since March of 2016. This is something we wrote about in the leadoff morning note this morning, in terms of, we're still very much not in the belief to touch China or anything very highly correlated to China with the 42-foot pole at this particular juncture. If you look at China through the lens of our four horsemen of economic risk, it fails miserably on three of the four horsemen. So on a demographic front, obviously has China on a 5-year forward-looking basis as poor demographics, particularly from the perspective of the growth rate, the projected growth rate of the working age population. Number two, on the leverage cycle front, you're seeing some evidence of adverse selection, some evidence of financial tightening in terms of China's credit cycle, which does not bode well as it relates to the propensity or the ability of the Chinese economy to sustain a reflationary impulse on the other side of kind of a mitigation or unwind of zero COVID. And then lastly, you have this sort of political risk associated with the inequality in the Chinese economy, which you can immediately observe through the Gini coefficient, things of that nature, other indicators like that. So if you sort of passing or failing three of those four very important tests, and you're having an overvalued stock market according to our relative valuation model, an overvalued bond market according to our relative valuation model, and a currency in free fall, I mean, there's just a whole host of reasons why China is not a great place to be in terms of putting your money. I mean, there will be a trade to long China and China-related assets, when the market really starts to get some confidence in a significant sort of change with respect to zero COVID. But again, we think that trade will be fleeting. At most, it'll last a few months, maybe a couple of quarters, because again, these sort of structural liquidity cycle dynamics, the liquidity trap that the Chinese economy is experiencing, in our opinion, is something that will be more of a longer-term driver for Chinese financial markets. Anyway, shifting gears into my Lombo dashboard, we'll go down global macro here to start. So the U.S. dollar, that is neutral from a short-term signaling perspective, momentum perspective, bullish from a medium-term perspective, get towards the lower boundary of the range. Gold, that's neutral from a short-term perspective, bearish from a medium-term momentum perspective, that's towards the upper boundary of the range there. 10-year Treasury yield, bullish on both the short and medium-term perspective, in the middle of the range. S&P 500, that's neutral from a short-term price momentum perspective, bearish from a medium-term perspective, in the middle of the range. VIX, bearish on both durations in the middle of the range. NASDAQ 100, bearish on both durations in the middle of its range. Russell 2000, that's bullish from a short-term price momentum perspective, neutral from a medium-term perspective, also in the middle of its range. We got our friends over in the crypto sphere, and we appreciate you for joining them and tuning into the program. We obviously got a lot going on in terms of FTX, Alameda, Binance, et cetera. It's very, it really does remind me of a lot of what happened in 2006 and 2007 in terms of the bigger firms starting to acquire the smaller firms, because they saw great prices on the screen, but not necessarily understanding and realizing that the cycle, the broader net liquidity cycle, the broader macro cycle, was actually going to get much worse, and they should probably wait on buying some of these assets. And so you're seeing Binance, kind of blow out of all of it. I want to say it's, it's FTT or whatever the coin is for the FTX. And is a function of that and trying to ring fence itself from the risk that Alameda ultimately will have. But again, this sort of acquisition, if you will, this sort of liquidity, this influx of liquidity for FTX specifically, in our opinion, we think it sort of has a lot of the old kind of Bear Stearns. It kind of feels like Bear Stearns, to be totally honest with you. So again, I want to say there's a lot of really good, awesome, thoughtful things that are happening in the digital economy ecosystem, things that are revolutionary for both society and the global economy at large. And we're very much on board and in support of that stuff and cheering it on, quite frankly, because we do need to see some continued innovation as it relates to finance. But the concept of the person A having savings and person B needing money to consume or invest, needing more money than they currently are generating to consume or invest, and therefore needing investment from person A whose savings that aren't being used in the particular present time. That concept of lending money or allocating capital and trying to find that make the process of person A giving person money B as sort of frictionless as possible. We've been doing that since biblical times. Crypto is not doing anything new as it relates to changing how you and I interact from the perspective of consumers, investors, and savers. All they're doing is taking this age-old 10,000-year-old concept of one person not needing money and the other person needing it now, and making it more sophisticated, making it more sort of thoughtful, and hopefully making it better for the world and for the broader use of society. But that doesn't necessarily mean that they're inventing the wheel as it relates to finance. So what I'm really trying to get at is it's very important for folks in the crypto ecosystem to study TradFi. Don't just poke your nose at TradFi and say, well, that's stupid. We're going to do it our way here. There are many lessons to be learned from the failures of TradFi, like the failure of acquiring Bear Stearns, or failure of acquiring a Countrywide or Washington Mutual in 2006, 2007, et cetera, heading into the 2008 crisis. There's so many parallels to what's happening today in the crypto ecosystem to what happened in 2007 before we even saw Lehman Brothers go bankrupt in 2008. So I just want to make sure that everyone's not being, I want to say a snob about this whole concept about what is digital what is this entire ecosystem? Because it's beneficial, but hugely beneficial for society, but it doesn't necessarily mean that there aren't lessons to be learned from traditional finance. Because again, very clearly, as you can see on the screen here, going back to my rundown of global macro. So appreciate again, I keep getting positive feedback from these rants, so I'm going to continue to do them. But anyway, Bitcoin's obviously oversold here. You got neutral short-term price momentum. Going to be bearish in a second if it stays like this. Bearish medium-term price momentum. So that's nothing new there. You got Ethereum here. It's oversold, neutral on both a short-term and medium-term price momentum basis. Pretty nasty correction. We by the way, on November 1st, what's November 1st? Where's November 1st? We said Ethereum was overbought. We said Bitcoin was overbought, and that the investors would probably do well to book some gains. $55 a month for lead off morning note. If you lost more than $55 in the last week of Bitcoin and Ethereum, maybe you would have benefited from that signal. Maybe you would have also benefited from the additional month of education that you get from actually subscribing to the lead off morning note. But again, this isn't a marketing program for 42 Macro. It's just a reminder that there's a better way to do this thing we call investing. And we're certainly part of the solution. Anyway, Shanghai Composite, neutral from a price immediate term perspective, bearish from a medium term perspective, neutral from a short term perspective. Crude oil in the middle of its range. Crude oil bullish from a short term perspective, neutral from a medium term perspective in the middle of its range. Ag, that is still neutral and bearish, as is industrial metals. Both are towards the lower boundary of their respective range. And then lastly, clicking into my free daily alpha tab, where we sort 300 ETFs or so, thereabouts, all representing individual factor exposures. What we're trying to do is help you identify things that are most overbought and most oversold, so that you can maybe think about putting on some trades today. For those of you who like to trade tactically, with options, et cetera, et cetera. We know there's a large and growing cohort of investors that manage risk in that variety. Anyway, Euro. One of the most overbought things in the dashboard today. Neutral from a short-term and medium-term signaling perspective, getting up there towards the upper boundary of its range. This is the FXC, the Euro ETF. Not quite overbought there, so be aware of that. But pretty significant implied vol discounts here, minus 19%. That's not what you want to see in the context of trying to chase something that's towards the upper boundary of the probable range. In fact, it's exactly what you want to see if you're trying to short something like the Euro there. What else? Scrolling down to the bottom of my tab here. Oh, we got some oversold signals. You might have guessed it. So we got BITO, which is a Bitcoin ETF, BITO. That is oversold with a humongous implied volatility premium, 203%. I mean, that's, please don't run out of short Bitcoin today. Like at the bare minimum, this thing is oversold. It's got a massive implied volatility premium that's telling you that everyone agrees to agree in terms of the short-term, immediate-term price momentum, and that's exactly where you want to be fading that as a trader. Now, again, Bitcoin is probably, as I said this, I definitely said it in February or March. I know for a fact I said it in April. So sometime between February and April, I gave a price target of Bitcoin that was $13,500. Do we still think Bitcoin has potentially to the downside to go to $13,500? Doesn't mean have to go there today. Doesn't have to go there tomorrow. It can go to 17,000, back up to 20,000, back down to 17,000, break 17,000, go to 15,000, back up to 17,000, break seven or touch 18.5 again and go from 18.5 to 14 to 13.5. Markets don't go anywhere in a straight line. Markets dance. They don't go straight. They don't go anywhere in a straight line. They dance. They wiggle. And what we're trying to do with this dashboard, not we, I don't work for Longbow. I think it's a fantastic tool. But what I'm trying to do in these macro minutes is give you the setup to take advantage of these sort of tactical moves in financial markets from a short-term signaling perspective. Obviously, we have our core investment views, our core positions in our own respective portfolios, but there are opportunities that the market presents you every once in a while to take advantage of some dislocations, take advantage of other people like Sam Bankman-Fried needing liquidity, so you can supply them with liquidity at this particular juncture. That's typically how you take advantage of these setups as a trader. So GBTC, similar setup as well. I don't think it has liquid options, so you're not seeing that same implied volatility premium there as well. But obviously, it's likely to mimic that same exposure. So with that, Darius Dale presenting our macro minute for Wednesday, November 9th, 2022. I hope everyone got some out of the rants. They're not all going to be A pluses, but certainly, hopefully, everyone's learning out there. And oh, by the way, got my friend Andy Constant over at Damstring Advisors today at 11 a.m. For our Macro Bundle Live program. We do that once a month with a thought leader in the space. We know it's a great opportunity for us to pick his brain for him to sort of kind of present to our audience, for him or them to present to our audience, and we all benefit from that sort of learning journey together. So we talk about a lot of published 42 macro research in these programs. So we don't publish these discussions beyond our paywall, specifically because, again, we're talking about our slides and our slide deck. We're talking about portfolio construction. So it's a real kind of open, honest conversation about what the hell is going on in macro and what can we learn from these other thought leaders in the space. So definitely be a subscriber to the Macro Bundle if you want to check that out. Or if you're a Pro subscriber, obviously you know where to find it. So thank you. We'll catch you back here tomorrow. Cheers. Have a great day.